So attendance question for the day. Are you going to be attending today's job fair? 1 to 4. Yeah, 20 minutes, half hour, whatever it takes. Experience, get a feel. That's my question for the day. Chat question for the day. That's our attendance. Got 4 answers so far. I want to give you all credit for being here. Because you're all here. You deserve the credit. All right. So let's go ahead and what's it from 1 to 4. And again, you don't have to be there for the whole thing. Even if you can take a break and wander in to see what it's like, it's good exposure. And as I said, the best time to go to a job fair is when you don't need a job or don't need an internship. And the second best time is when you do. All right, we're going to wrap up chapter 13 today, and we're going to get some introduction to chapter 8, just fixed assets. We'll continue on our balance sheet as we analyze accounting terminology and accounting environments. So I'm going to go ahead. I'm going to share my screen. I'm going to go over to chapter 13 and finish off what we're talking about. All right, so let's go ahead and advance to the portion of the screen, and we're going to break this down a little bit. So when we were here last class, we covered horizontal analysis pretty completely. Horizontal, also known as trend analysis, is when we're looking at year-to-year comparisons. We're taking current year minus prior year and dividing by prior year to see the increase. Now we're going to take a look at our vertical analysis, also known as common size statements. And the analysis we just did on Apple, on Edgar, was common size. We looked and we said, okay, what is their net income as a percentage of net sales? What is their gross profit as a percentage of net sales? What is their SG&A, selling general administrative, or R&D, research and development, as a percentage of net sales? So vertical analysis on our balance sheet looks something like this. We have our cash and cash equivalents, 1%. I'm sorry, 5.4%. Not wearing those 2 years. 5.4%. Current year. Last year was 6.4% as a percentage of total assets. Now, total assets increased from $321 billion to $375 billion. So our actual dollar amount went down a little bit, but our percent of total assets went down a whole bunch. And you look at the big numbers, long-term marketable securities, bigger ticket. Accounts payable used to be 11.6%, now it's 13%. But if you look on a year-over-year basis from 37 to 49, that's like a 33% increase, about a third. You're almost $13 billion up. But it was only let's see, 11, 12, 13, 1.5% increase as a percentage of total assets, which are up. And then we look at the big tickets like long-term debt. We took on a whole bunch. We were 75 billion to 97 billion, about a third up again. But now it's only 23% up to 26%, 3%. So that's an analysis on the vertical analysis on the balance sheet. If we're doing a vertical analysis of an income statement, just like we did for our Apple stuff, there it is, net sales at 100%. And we look and say, oh, sales are up. It's a few years back. And then we actually improved from prior year to current year. Our cost of sales actually got worse. I didn't improve. Got larger as a percent, which means we had a smaller gross profit percentage. You can bet the folks at Apple looking at that saying, wow, why are our costs going up for our stuff? And they're going to try to do something about that. That's what you analyze. You got R&D is up as a percent. Even though sales are up, Our R&D is up even more as a percent. So it's exceeding, it's growing faster than our sales is growing. And our net income, about the same, 21.2 down to 21.1. Common size graphic gives you a bigger picture. Stacks things, pie chart, stack bar, whatever it takes to make a picture and show you what's going on. And you'll be doing these in your projects too. You'll be going ahead and you'll be adding to your information by visually presenting. You've been doing some Tableau analysis as part of your homework. You've been reading, looking at charts, looking at graphs, looking at images, and interpreting them. And as part of your project, you will be creating something. Doesn't have to be fancy, but it will be interesting. All right, let's start talking ratios. Liquidity and efficiency ratios, all this short-term stuff, anything with a current asset or current liability. Solvency, debt to asset, debt to equity, debt ratio, equity ratio. Those are the debt to asset is your debt ratio. Equity to asset is your debt equity ratio. More longer term stuff, including the short term and long term, the current and the non-current. Profitability, anything with the word net income. Earnings, as in earnings per share. Return, as in return on assets or return on equity. That return, net income, or earnings are all the same number. The bottom line profits, bottom line net income. So we'll look at some of these ratios. You've seen them before, you'll see them again. You know the current ratio, asset test. In the chat, is the asset test ratio always going to be larger or the same or smaller or the same? Yeah, we'll just use larger or smaller. Is the asset test going to be smaller or larger or smaller than the current ratio? In the chat, take a shot. Larger or smaller, 50-50. Two answers so far. Looking for a few more, please. There we go. So I'm getting, this is one of the, you're trying to do the depends trick on me. This is one of the few times it doesn't depend. Think about it, the current ratio, if we draw it out, it's current assets over current liabilities. The asset test ratio is current assets minus, I'm going to put X here for now, divided by current liabilities. The numerator is going to be smaller or the same. What's that X? That X could be inventory. That X could be prepaids. The stuff that's not cash, not receivables, not real short-term liquid, it's called the quick assets. The current assets, less the prepaids, inventory, and some of those longer-term things are called the quick assets. That's going to be a smaller number. If the numerator is smaller and the denominator is the same, it better be smaller. Now, sometimes company may not have any prepaids or inventory. And if that's the case, it'll be equal. So if you put it depends, okay, that's what you were thinking. Thank you. You were thinking equals or smaller. That's okay. But realize that 99.8% of the time, it will be smaller. All right, let's look at receivable turnover, inventory turnover. Remember, if it has a balance sheet item and an income statement item, you have to take an average of the balance sheet item. Notice we didn't take an average of current assets or an average of current liabilities, because those are both in the balance sheet. But we do on inventory turnover, we got two things. We've got our cost of goods sold, and we've got our inventory. Which of these is the bigger number? Inventory goes up and down, up and down, up and down. Cost of goods sold goes up, 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 up. Bingo. Cost of goods sold is going to be a bigger number. We put that in the numerator. And then we have to take something called average. Right? If we've got an income statement item, cost of goods sold, and a balance sheet item, inventory, but that's a point in time. We got 2 points, got to take an average of those 2 points. Same idea for receivables turnover. We've got receivables and sales, which is a bigger number. Let's see, receivables goes up and down. Sales keeps going up, hopefully. Sales divided by average AR. And then we have total asset turnover. This one, I need to figure out how many times have I sold my assets. So I've got sales and I've got assets. Now, this is not a case of which is a bigger number. This is a case of how many times did I sell my assets. So if I had $10 million in assets and I had $20 million in sales, I would sell my assets twice. So I would put in the numerator sales, the denominator assets. So if I had something like 20 million in sales and 10 million in assets, I would have an asset turnover ratio of 2. Does that make sense? So sales are like in our accounts receivable turnover, we put sales in the numerator. In the asset turnover, we also put sales in the numerator. So we want to see how many times do we sell our assets. Now, sometimes we might have 20 million in sales and 40 million in assets. So we sold them a half. We sold half of our assets in the year. We did another 20 million next year, we'd sell the other half, in essence. But we're just analyzing what's our relationship between sales and assets. So that's our asset turnover. Now, that's not so much liquidity, that's more of a longer term, but it's still, so they call it an efficiency ratio. How efficiently are we using our assets and making our sales? Now, somebody might say, what's our sales per employee? Yeah, that's not a ratio, that's calculated as a ratio. Number of employees, dollars in sales. What's our sales per square foot? Retailers like to do that one. What's our overall sales per square foot of retail space? So again, I'm reviewing the ratios. All of these are ones I want you to be comfortable with. And we'll talk about days sales uncollected and days sales inventory. Now, typically, we take 365 divided by the turn. So if the inventory turnover is 10 times a year, that's 36.5 days. Now, if our inventory turnovers receivables turnover is 10, our days is 36.5 days on average to collect our receivables. Okay, nothing real fancy about that. The catch, though, is in finance, they don't take the average inventory or average receivables. They take the ending inventory and ending receivables. And you see that in the book, too. Either way, as an accountant, I prefer taking the turnover ratio, which takes the average, is a little bit more reflective of the year. But if you take the 365 and they have you multiplied by the inventory, ending inventory divided by cost of goods sold, they kind of flip that times the 365 and you're good to go. So that's kind of how we'll memorize that and be aware of that. Let's keep going with our ratios. Now, working capital is not a ratio. Working capital is a calculation. If I have, let's do some numbers here. If I have $20 million in current assets and $10 million in liabilities, what's my working capital? Oh, 10 million. I can do that. I can do that without a calculator. So can you. How about if I pay $5 million worth of bills out of cash? So what happens to my current assets? Oh, that goes down to 15. And my liabilities go down to 5. Oh, that's the same number. I got 10 million in working capital. That's cool. But what about my current ratio? What's 20 million divided by 10? Again, don't take out a calculator yet. Hopefully you get 2 when you calculate that out. What's 15 million divided by 5 million? Well, the millions will cancel out. I get 3. So our working capital didn't change, but our current ratio did. That's interesting. At least as an accountant, I think it's interesting. I pay some bills and I affected my ratios. That's how it works. I'm actually more liquid right now. I only have 5 million liabilities with 15 million of current assets to pay it. Before I had 20 million in current assets to pay 10 million. I was a little less liquid. Still pretty liquid because I got plenty of current assets to go around. But if I asked you a question on an exam and said, well, if I pay some bills, does my current ratio go up or current ratio goes down? Now, that would be a trick question because when my current assets exceed my current liabilities, the ratio is going to go up. Let's flip it. Maybe I had 10 million in current assets and 20 million in current liabilities. So I have negative 10 in working capital. I still pay $5 million worth of bills. So now I've got 5 million in current assets and I got 15 million in current liabilities. I still have a negative 10 in working capital. But what's my current ratio? Well, 10 over 20 is 0.5. And 5 out of 15 is like 1 out of 3 is 0.3333 repeating. So if my assets exceed, my current assets exceed current liabilities, my current ratio goes up when I pay bills. If my current assets are less than my current liabilities, I go from 0.5 to 0.33. That sounds like a decrease to me, doesn't it? That's a smaller number. So it actually goes down here where it goes up here. So the best way to answer that question is to plug some dummy numbers like I just did. If I ask you a question, my current assets exceed my current liabilities, and I paid some bills. What happens to my current ratio? Rather than memorizing, okay, let's see, it goes up because that's what I memorize. Better to throw some numbers at the problem and figure it out and see where it goes. You'll find that in managerial accounting as well. Often throwing numbers will give you a better indicator to help you understand the concept without having to memorize the rules that go with that. So plug the numbers in, get the results. Any questions on that? Are we comfortable with some basic number crunching like that? I know I'm saying basic, but hopefully it's basic. So we just went through the current ratio, current assets over current liabilities. And then the asset test ratio doesn't include as many current assets as the full current ratio does. So we got a smaller numerator and we're going to have a smaller number, 99.8% of the time. That's assuming we have inventory. It'll be 100% of the time. We have our receivable turnover. We're taking our average receivables and sales. We've calculated those before. We've already done our inventory turnover, average inventory. Here's that days sales collected. Is that net sales over average AR for a turnover ratio? And then divide that into 365. We're just taking the accounts receivable net end of the year divided by net sales times 365. Okay. And that's how the finance folks do it. I won't fight them. Inventory the same way, days sales and inventory. 30 days worth of inventory turnover for there. 35 days, 40 days, 120 days, whatever it might be. Total asset turnover, net sales, like receivables, and the receivables turnover has net sales numerator, divided by our receivables, average receivables. Here we have net sales divided by average assets, not receivables. Then we have our solvency ratio. And I'm not too worried about times interest earned. That's one of the ratios. How efficiently can we pay back our interest? I'm not based on net income. I'm not worried about that one. But the other three, debt ratio, equity ratio, which is in relation to total assets, and then the debt to equity between themselves. And again, that should be reasonably easy to calculate and make sense of. So debt ratio is roughly 64%. Equity ratio is 36% for a total of 100%. Now, if we notice our liabilities are almost double our equity. So if we do a debt to equity ratio, we have almost 2. But here we got 64% of our balance sheet is liabilities. 35.7% of our balance sheet is equity. And the catch is you may have to calculate total liabilities. Some balance sheets show total liabilities and some don't. As a matter of fact, I want to go back up here to our balance sheet. We had a balance sheet that we looked at, common size balance sheet. Okay. And here they show total current liabilities, total stockholder equity. A lot of balance sheets will show you total current liabilities. Then they'll say, oh, we've got deferred revenue, non-current, long-term debt, and other non-current liabilities. Then they jump into equity. And you say, wait a minute, you didn't give me the total liabilities number. I can't do this. If I want to know what my debt ratio is, I need total liabilities, not current. And by the way, I hate to tell you how many people initially will tell me my debt to asset ratio. They'll take either they'll give me a 1, because they'll take all liabilities and equity divided by assets. And that's not right because you're including equity. Or they'll take the current liabilities, because that number's calculated for you, and total liabilities isn't. So you might have to manually go in and say, oh, I need to take my assets minus my equity to get my total liabilities. But here you don't have to, it gives it to you. But if I took my 375 minus my 134, I'm going to get to 241. Them's the rules. We're in balance. Our balance sheet stays in balance. So if you don't have that liabilities number on your balance sheet, don't worry about it. You can calculate it. If we go back to our income statement, you'll notice, let's see, yes. Okay. Sometimes we're not given a gross profit, a gross margin. We're given a sales, then we're given expenses, cost of sales, R&D, SG&A. You might have to manually calculate your gross profit yourself. A little extra work, but if you're on a spreadsheet, not a lot of extra work. Is that making sense? We're on the same page with that. Nothing fancy about the numbers, just playing with them, getting used to them, and taking care of understanding. Okay, so let's go back. We have debt to equity is total liabilities over total equity, not total current liabilities, by the way, all liabilities, current and non-current, divided by total equity. I told you time interest earned, I wasn't going to worry about it. If you want to memorize it, more power to you. Income before interest and taxes divided by interest expense. So if you had 100 million in income and 10 million interest expense, you earn 10 times your interest. Just an investor likes those numbers sometimes. Might be an extra credit on a quiz someday or a test someday, but not actually be responsible for that. Then we got profit margin. By the way, this is net profit margin, not gross profit margin. Return on equity, return on assets. Again, that's net income. So there's our profit margin, net income over net sales. I wish they put the word net in front of that, but think net. So think that right here, you've got the word net coming at you. Net profit margin. There's a gross profit margin. Yeah, you know what that is. It's net sales minus cost of sales or cost of goods sold, yielding a gross profit. But this is a net profit margin. This is your bottom line. And we get return on assets. We have an income statement and a balance sheet item, so we have to average our assets. We got a return on equity. And again, I told you not to worry about preferred dividends, right? I said preferred dividends until we get to our equity section. Most companies don't have preferred dividends. I'm working on a startup right now. We're going to have common stock Class A voting, common stock Class B non-voting. We're not going to have any preferred stock. We don't have any treasury stock. We're not going to buy anything when we issue it. But you think about that and said, wait a minute, we know about Berkshire Hathaway, and we talked about their share price over $400,000 for one share. That's their Class A stock. Their Class B stock is about between $250 and $350 a share, depending on the day and where it goes. And it has a different structure and different profit sharing and a different orientation. So if you can't afford $400,000 per share and you want to still be part of the Berkshire, you can buy a partial, you can buy a tenth of a share or even smaller denomination of Class A, or you can buy the Class B stuff. But there's two classes and they have different rights, privileges, and different ways of sharing in the income. And usually the Class B does not have voting rights. So the family that owns the company usually keeps the voting rights to themselves. Anheuser-Busch used to have two classes, one for the family and one for everybody else that wanted a piece of it that drank beer. Okay, so we're going to clear that out. And the market prospects, I'm not going to worry about it for this class. That was that fourth category of ratios. P to E ratio, price of it per share and earnings per share. That's just a multiple. And investors use those kind of numbers all the time, where a utility has a lower P to E ratio than a high-tech company. That's a potentially higher return. And then dividend yield, I'm not worried about, because a lot of companies don't pay any dividends. They pay zero. So the dividend yield will turn out to be zero. So our P to E ratio, market price divided by EPS, dividend yield. Again, if your dividends, annual cash dividends are zero, makes it a very easy calculation. Zero. So as a summary of the ratios we're looking at, that out, expand it up a little bit. So I told you we're not worried too much about some of these ratios. I expect you, and we'll probably see a quiz, if not next class, the class after that, and I expect you to have these ratios top of mind. You're not going to have a lot of time to go, well, let me look it up and let me figure, no. Current ratio, you got it. Current assets, current liabilities. Asset tests, receivables, short-term investments, cash. Receivable turnover, oh, I got sales and average AR. Inventory turns, days sales inventory. Total asset turnover. Solvency, debt, equity, debt to equity. This is also your weekend project for your discussion. So pick a company, do the financial analysis, pop it into the spreadsheet. Times interest earned, I said not to worry about that one. Profitability, yes. And they say gross margin ratio, gross profit, same thing. Don't worry about that. ROA, yep. ROE, yep. Book value, common share, not too worried about book value. Basic EPS, don't worry about preferred dividends. I'll take that out of return equity too. Preferred dividends, we're not going to worry about that. Any problems I give you right now won't have them. The final might, because we're going to be talking about preferred dividends. But again, most companies don't have preferred stock. And so you don't have to worry about it. It's not common dividends. Common stock dividends are the stuff they give out to the owners. Preferred dividends are only issued on preferred stock. And you don't have preferred stock, ain't got nothing to worry about. Nothing to worry about there. P to E ratio, not going to worry too much about that. Dividend yield, yeah, we're clear on those. So that's where we're at. Those two, that's the table in the book. And yeah, but I do expect you to have a pretty good handle on the other ratios. Any questions on that? Anything you want to talk about? All right, gonna take a quick pulse. Let's get cameras on for everybody if we can. I like to see your faces. I'm actually going to ask for your hands. My question to you is, how are you feeling? Counting? Yeah, I think I got it. I think we're in good shape. I need a little more work. I got a little more studying to do to catch up on a couple of things. Or it's been a long semester and I'm burned out. Okay, got some ups, got some mediums. No thumbs down. That's a good sign. Good, good, good. Thank you. In the chat, please put what you think is most frustrating to you. Maybe a couple of things. And it could be anything that we talked about. It could be ratios, it could be debits and credits, it could be inventory, it could be balance sheet, income statement, understanding terminology. What is it on your mind that you feel is most challenging to you? Go ahead, pop in the chat. Yep, catching up from being absent. I respect that. I understand. Still on the debits and credits, okay. But ratios and inventory. Inventory is not natural. It feels kind of funky. And that takes that, LIFO, FIFO, here's the last one I sold. The key is knowing that it's either sold or still here. And which ones did I sell and which ones didn't I sell? That's the analysis. The formulas shouldn't be too hard to memorize because they're self-explanatory. Return on assets. Okay, that's net income over average assets. Return on equity. Current ratio, I got that. Earnings per share, earnings over shares. Oh, okay, hey, I got that. Now the receivable turnover, inventory turnover. Yeah, we spent a lot of time trying to remember what two numbers go in there and which one's the bigger one. So this should be becoming more natural. Yeah, the bank reconciliation can be a challenge sometimes, knowing what the bank knows versus what you know. And those are the kind of things. So now what you typed into the chat are the kind of things you probably need to emphasize on the studies. When we have our on ratios, hopefully you'll have a pretty good handle on what ratios are and what we're talking about. All right, I'm going to do a quick jump. I'm going to do a basic preview to chapter 8, which is our fixed assets. So I'm going to share my screen and then we're going to call it a day. So our chapter 8 stuff, if we're looking at chapter 8, let's go ahead and share. I'll just intro at basics of what we're going to talk about. And if you're looking at this stuff, you're saying, we've already done fixed assets. It's the stuff that lasts for more than a year. It's kind of capital equipment, capital things that we purchase. Gasoline that goes in the car doesn't last more than a year. We're going to expense that. But if we buy a building or we buy a car, hopefully it's going to last more than a year, unless we total it, unless there's a fire. But technically, theoretically, it should last more than a year. We're going to have it on the balance sheet as a fixed asset, also known as property, plant, and equipment, PP&E. So, computing the cost of plant assets, we'll talk about. Partial year depreciation. Now, if we buy something July 1, we have a 12/31 year end, and we only have the asset for 6 months, you might want to take a full year's depreciation, but you can't. Now you say, but I bought December 1st. I'm going to take a month's depreciation. Or I bought it January 31 or February 1. I'm going to take 11 months. Yes, you can do that. We're going to have to worry about half a year depreciation or quarter of a year depreciation. We'll talk about the mid-year convention. That means if you buy it in January or November or August or June, you're going to take a half year the first year. That's what the IRS does. Makes it easier than trying to track how many days we own this thing and days out of 365 and all that stuff. We'll talk more about revenue expenditures versus capital expenditures. We'll discuss asset turnover, just same way we had inventory turnover. And then we're going to have a couple of ways to calculate depreciation. Straight line we've been doing, they're pretty good. We got car for 5 years, it costs 20,000. 20 divided by 5, that's 4,000 a year. Assuming no residual. But now there's some accelerated methods. You drive it off the lot, that car loses 10% in value on the first mile typically. So we may want to accelerate the utility of a vehicle or machine. It takes more maintenance in 2 or 3, 4 years. So we want to take more depreciation in the current year and then make up for it with the maintenance costs in the future years. Natural resources and depletion. How much oil is in the ground and how much have we used up? How much gold or silver or copper in those mines? How much have we mined? So we'll talk about depletion. And then the intangibles. Intangible assets like copyrights, patents. We'll touch on those. So that's where we're heading in chapter 8. Any questions before we part company? Wish you a good Wednesday. Look forward to seeing you on Friday. Thank you for the opportunity to share. Have a good one or two.